A very good evening to all of you. My name is Mohit Bhatnagar, and I'm going to be the moderator for this session today. First of all, a very warm welcome to all of you. Today's topic, as you see, cash, courage, or caution. So, while we were discussing and analyzing the topic for this season, we thought that it will be prudent to understand from our speakers today that what is it really working in the equity markets nowadays, whether it is a time to show some courage, increase allocation to equities, or should we hold and tread with caution, or is it just safe to have some cash, some dry powder at hand, and maybe wait for the opportune time to come and hence deploy? Dear investors, if you see last 1 year has been a very topsy-turvy ride in our equity markets. Even on a global front, we saw markets like US, there are efforts being made to reduce interest rates. On the other hand, markets like Japan, where after a long period of time, we have seen the interest rates have started inching up, or whether it is economic stimulus announced by the Chinese government to help their industries. In addition to this, we also saw some political developments, the biggest one being that the announcement of presidential election and subsequently the result in US. Also some political turmoil which we witnessed in countries like France, Germany. India, on the other hand, has largely been a stable economy, a stable ship. However, we have also had our own fair share of troubles, turbulences, and volatilities. So today, uh, with George and Abhilasha, who are our senior equity fund managers, we would like to understand what is it that we are reading in terms of the valuations, the earnings, and what are those key economic indicators in the markets which we should be watchful of, and hence should decide whether it is time to be courageous or be cautious or just keep some dry powder at hand. So I will, with this, over next 40 minutes, we will be sharing a couple of slides with you, which are our views on the markets, a bit of information on our funds, opportunities in small cap space, value space, after which we shall be taking some question and answers. While I have already started receiving some questions, but dear investors, kindly hold on. Please allow us to present and then we shall definitely be taking your questions. So with this, I hand it over to George for the presentation. Over to you, George.
Thanks, Mohit. Thank you everyone for joining in this evening. So I'll talk about how the earnings trend has been panning out in the markets and how as an investor you could uh, capitalize on these trends. So before we jump into the topic, I'll give you a quick overview about Quantum. Quantum was founded by Mr. Ajit Dayal in the year 1990. Quantum was we were the first institutional equity research house. And in the 90s, we partnered with renowned global institutions like Jardine Fleming and Hansberger Global in our 90s. And most of our learnings on how to manage funds and investments that happened during this period. From 97 to 2004, we were advisor to Hansberger Global Investors, where we were advisors for their India portfolio. And during the same time, Ajit was a lead fund manager for the Vanguard International Value Fund, which at those times commanded an AUM of about $2 billion. So the India PMS was launched in the year 2000, which is currently operated under the parent level of at the Quantum Advisors Private Limited. And at the current stage, we manage an AUM of close to about 20,000 crore in that under Quantum Advisors. Quantum Mutual Fund was launched in 2006, and we have had a very calibrated approach in terms of launching funds and clearly ensured that every product is complementary rather than just building the list of products. So, and as of now, our AUM is slightly more than 3,000 crore, but it's on a growing phase. So, with that, I'll shift to how we are sensing the current market scenario and how our portfolios are positioned towards that. So, if you have read a lot of these recent news articles and even some of the commentaries on business channels, you would have been worried about the corporate India's performance, where the earnings growth and the revenue growth has been tepid for the last 3-4 quarters. And one of the main reason for this has been quite stellar growth after the COVID, which you can see in this graph, where the blue line, which represents the sales growth, has been very strong between March 21 to April 23 in this period, which you can see. That was a result of accumulated savings during the lockdowns and when the activity was down after COVID. And therefore, the growth was super normal in this period. And in the recent 3-4 quarters, that high base or that high ask rate or the high growth rate which was demanded was on an abnormally high base, and which translated to fairly low numbers or single digit numbers or less than 10% kind of numbers. But in the recent quarter, in the March 2025 quarter, when we look at about 70% of the companies which had declared results until a couple of days back, the trend seems to be slightly reversing, while the sales growth still continues to be on a lower, on a single digit space. We are seeing some bit of improvement in profitability. And as a result, we are seeing the earnings growth is kind of coming back. Of course, if we remove financials and certain oil and gas companies where the benefit of lower crude prices were high, the growth numbers would moderate a bit, but still it is reporting a reasonably good uptick. So that is a broad trend which we are seeing. And our sense is with the current base year of fiscal year 2025, where earnings growth has not been that great, and we are seeing certain tailwinds which could be supporting the market in the months and years to come. And therefore, our sense is things from here on should be a lot better. But the impact of high base is also visible in that the bottom right table, where we have seen the long-term growth trends, where it appears fairly strong, which is showing a sign that the recent periods or the growth rates which we saw in recent periods was influenced by high numbers on the base year. So when we look at what could prospectively happen in the next few quarters, so some of the tailwinds which are there for markets, one, the inflation has fallen quite rapidly. And this is a chart which shows the consumer price inflation, and that depicts how prices move in an essential basket of essential basket which is used by household, which includes foods and certain essential services. And here we can see inflation has been rapidly falling, and the recent number which has come is just a little over 3%. And what would happen when inflation fall? As consumers, as individuals, you will have more money to spend on other things. You would start buying clothes, buying vehicles and things like that, because you have surplus money after you spend on your essential things. And since therefore this is a very positive sign from an earnings growth perspective, or from a corporate perspective, from a company's perspective, you'll have better demand for your goods and products. Along with this, we are seeing as the inflation is coming down, the central bank or RBI would have more room to cut interest rates. So when the inflation stays high, RBI or central bank would be very worried in terms of if the economy could overheat, or things could go where inflation, if interest rates remain high or they keep it at an elevated pace, we might see the price hikes could be very high. But in a soft inflation environment, or when prices are falling, a central bank would have scope to reduce interest rates, and that would give an impetus to growth on an even further scale. And if you have many loans, or if you're taking fresh loans, that would reduce the interest outgo or the monthly payments which you would have to make. So along with it, the other positive news which is coming up is in terms of monsoon forecast, that has come up normal. And even in many parts of the country, we have already seen some bit of rains already happening. And the importance for this as a country is, in India, more than 60% of area of the cultivated land, we are dependent on monsoon for irrigation. As monsoons become normal, you would see our crop output would be better. That gives an impetus to the rural economy and things like that. So some of the news flow or the earnings commentary, if we hear from companies, we have been hearing that the people in the urban cities or urban consumption has slowed down in the recent years, and government has given certain income tax rebates for that. So depending on the tax slab or your income levels, the benefit could be as high as slightly more than 1 lakh rupees. So all of this would give more money in the pockets of consumers, and we would see better spending in times to come. So another important pattern, or the pattern which has happened in the overall market is, so if we look at the period from 2003 to 2014, it was a period of two halves. If we were to split it into a period of two halves, 2003 to 2008, the market rallied tremendously, and there were flows from domestic as well as foreign flows, but foreign flows were were a lot higher. But in that after 2009 correction which happened during global financial crisis, we saw a lot of domestic institutional investors pulling out the money. And therefore, if we analyze that full block, the most of the inflows came from foreign investors. If you look at this $149 billion of flows which came between 2003 to 2014, almost 98.5 or 99% of the flows came from foreign investors. And as a result, during those time, so if you look at shareholding pattern or of the top of the Nifty 500 stocks, which is a predominant part of where investors can invest, you would see the amount of stock which was held by foreign investors, or more than 2x the amount quantum of shares which were held by domestic institutions. And therefore, our sensitivity to foreign investors selling were very high from a market perspective. So if foreign investors start selling, you would see large declines in markets. Similarly, in both ways. But over the last decade, what we have seen is, of course, the domestic institutional investors flows were very high. It was in multiples of what we saw from foreign investors. And therefore, the shareholding pattern, if we look at it, has kind of equalized. So the domestic institutional investors currently hold more than what foreign portfolio investors hold. This gives some bit of stability to the markets. But one can argue that if we were to see a 2008 or 2008 kind of correction, how could the domestic institutional investors behave? Or how would retail investors behave, and how that would translate to mutual fund? But an important point to note here is a lot of these flows have also been driven by EPFO and NPS, which are more sticky in nature. And therefore, the volatility which we could see, even if we were to see a retail redemption cycle, it may not be as sharp as what we would have seen in a historic period. So stock prices or market levels are defined by two things. One is a valuation multiple, like price to earnings ratio, and you multiply that by the earnings per share of companies. The same is true for even the index. So when we look at the valuation part, how the current valuation multiple or the current price to earnings multiple fair versus our historic 10-year median, we would see that in most of the sectoral cases, or even for the broader markets, the valuation multiple is around what we have seen the last 10-year average or 10-year historic median, which means there is not too much overvaluation in the market. Markets, from a valuation perspective, are trading somewhere near fair valuation levels or reasonable levels. But of course, there are sectors like capital goods or FMCG or healthcare indices where you are still seeing quite elevated valuation multiples like 40x or 40 plus x, and it is at a premium to its historic median. So there are pockets where there are overvaluation, but there is a large part of the market which are trading at reasonable levels. So this is how markets tend to behave over long periods of time. So in this graph, we have taken the long-term average price to earnings of Sensex, and we have multiplied that by the earnings which has panned out over multiple years. And for forward numbers, calendar year 25 and 26, we have taken the earnings per share of, as per Bloomberg estimates, where a lot of sell-side analysts estimate what could be the earnings per share of Sensex in the years to come. That is culminated by in terms of they add up all the underlying stocks earnings per share estimates, and that results in Sensex earnings per share estimates. So what we can see here is even from a CY24 or December 2024 levels, there is an earnings CAGR which analyst is forecasting to the extent of 12% plus. And if we were to believe that markets would stay around their long-term uh, multiple PE valuations, you can expect some bit of market growth in line with earnings per share growth. So as investors, how you can capitalize this in terms of investment solution. So I'll talk about how we look at asset allocation as a framework, and then I'll hand over to Abhilasha, where she would talk about how the global tariff scenario is panning out and how Quantum as a group looks at the small cap strategies. So we have a very simple approach for an investor where we advise investors to have an emergency fund, which can be 12 months of your monthly expense. It could be higher or lower depending on the stability of your earnings. And the remaining part, which can be attributed to for investments or for long-term investment planning, can be split between equity and gold in an 80-20 ratio. The reason why we suggest equity and gold is because they tend to behave in opposite fashion when there are crisis periods like global wars or recession, where equity might come down a bit, but gold tends to offset some bit of that losses during crisis periods. And we have seen this pattern has recurred historically during multiple crisis periods. And at 80% of the equity allocation, you can have multiple styles and strategies within that so that you would have a balanced experience over long periods of time. So as a group in Quantum, we are very much mindful about liquidity risk. So if the current flows into the markets, if that were to slow down, what could happen to our underlying stocks and what could happen to our portfolio? That's a very prominent thing which we follow when we design any investment product. And these are some of the news articles which came when markets turned volatile in the recent periods, where what could happen or how liquidity is drying up in certain illiquid strategies. So when I talk about the Quantum Value Fund, so one of the key tenets which we ensure is if we were to assume a 5-year holding period, and if you do not want to spend more than 5% of your time buying into a stock or selling out of stock, how the portfolio would look like. And we have taken very conservative assumptions here that not participating in not more than 1/3 of the daily volume which is traded on exchanges. And this is how the liquidity profile looks at. So there is not even a single stock which would require more than 66 trading rate days to liquidate in the current portfolio. And if we assume that the portfolio or the current AUM becomes 10x for the fund, this is how the portfolio liquidity characteristics would show up. It is still none of our stocks would take more than 66 trading days to liquidate. And this is a very powerful thing to note, because even if I were to scale up our portfolio or the AUM to multi-fold levels, the same characteristics would continue whatever track record which you have seen in the historic period, we would be able to replicate even going forward. But this may not be the case if I run an illiquid strategy where I would have to accumulate more number of stocks or invest into a different kind of stocks where I may not be able to replicate my historic track record. And another important way in which you have to evaluate every fund is how it behaves during a bull market and a bear market. For instance, if you were running a full marathon and if you came out to be the lead or the front runner until half of the race, and if you lose all the energy by the second half and you tend to wobble in the second half of your marathon, and you might end up being the last, or you might be left behind as the marathon kind of ends. This is an analogy which you can even imagine in your fund's performance. So as much as it matters how your fund performs in a bull market, it matters in an equally important or a higher manner how your fund would behave in a bear market or when markets turn volatile. And this, in technical terms, is captured by two ratios called as up capture and down capture, which means how well your fund is performing when the market is moving up, and similar way when your market is moving down. So in this table, you would see the up capture and down capture ratios of quantum value fund versus its index, which means in an up market, if the index moves from 100 to 200 by 100%, you would capture 87% of that. Your fund might move to only 187 at that instant, and you might be underperforming by a mild margin. But when the cycle turns and when the index goes from 200 back to 100 or 150, if you manage to preserve your capital to a better extent, in this scenario, when the index moves from 200 to 100 to 25 or 24, you're losing only 76, which means you're left with more capital to play in the next cycle. So this is an important metric as investors when you invest in any fund. So if you manage to have an upside capture ratio or up capture ratio more than down capture ratio, you would ensure that a reasonable performance is achieved over long periods of time. And this is how it pans out versus our tier 2 benchmark. The ratio or the direction, it does not change materially. And this quantum value fund has depicted this in multiple cycles across history. In every bull market, it might perform similar. It may not show too much outperformance, but when market turns volatile or when a bear phase kicks in, that is when you would achieve a lot of your outperformance. And this has played out in most of the historic cycles, like 2009 to 10 or 10 to 11. Whenever you take a bull markets, it performs very similar to index or pretty close to that. But when the bear market phase starts, it falls a lot lower. The only exception is a period from 2016 to 20 where we underperformed. That was for a reason that it was a concentrated rally where very few stocks participated, and it was primarily driven by valuation multiple expansion, which is not a fundamental way in which we kind of evaluate stocks in a value investing framework. And there was a corporate tax change during this period where many of our portfolio companies did not benefit because they were already at a lower tax rate. And this is how the fund performed over long periods of time. So here the orange line shows how we would have forecasted our NAV would have behaved on a 2-year prior basis. And the blue line shows how it has actually behaved. So except for global dislocations like global financial crisis or COVID-19, where our estimates materially deviated from what we forecasted, it has more or less been a close fit, which shows that the process has worked beautifully well over long periods of time. And even when there was a dislocation in a 2-year basis, it has got back to its long-term trend, which means that the current process which we have been following has worked phenomenally well over long periods of time. And this is how the current portfolio positioning is. So we are seeing better valuation comfort in some pockets like financials. which is primarily a mixture of banks and insurance companies, where we have a reasonable overweight position. And then there is about a 12% cash, which we can deploy if markets turn more favorable, or the upside or the return potential in our current holding companies turns more favorable. So those are the key points which I would focus. With that, I'll take a pause and I'll hand over to Abhilasha to discuss more about the fundamentals and our small cap strategy.
Hello, investors. So, we'll start with one major global event which has happened recently. That is, President Trump has imposed tariffs on most of the countries. In this slide, we can see that the tariffs which have imposed over the tariffs for a century. So, like before World War II, the US used to impose tariffs in the range of 50 to 60%. And now we can see that post World War II, there has been a deceleration in the tariff imposition because US was given most favored nation title, and therefore, overall tariffs imposition has decelerated. However, because the US has run into a trade deficit, and to curtail that up to some extent, President Trump is trying to rebalance it again, and he has put a tariff on most of the countries. So current tariff rate in US is around 2%, which after the recent tariff imposition, although there is an uncertainty on how the final tariffs could be, and the many countries are in talks with US for the bilateral agreements. But based on the current scenario, it is likely that the overall tariff uh, revision after the current tariff imposition is likely to be 10%. So US earnings from US collections from the tariffs are likely to increase from current 50 to 55 billion dollars to around 500 to 550 billion dollars. So this is like kind of some rebalance what we can see in the global economy. We are not saying that US is likely to be a major beneficiary of that, because it will have repellent impact on US economy as well. Apart from that, there could be one impact wherein the capital might flow away from US, because if you see in this slide, we are seeing that US weight in MSCI index has increased from 50% to 65% in last 10 years. So current US market cap is around 52 trillion, of which around 16 to 17 trillion is held by foreign investors. So if the global economy loses a confidence in US policy itself, there could be some capital flight away from US. And some of the countries like India or any other Asian countries or European countries could be beneficiary of that. uh, just if we see the impact on India, India basically is a consumption-driven economy, and the GDP contribution from consumption is one of the highest, which is at around 60%, as opposed to China, which is around 40%, and many other competing countries. So even if there is any tariff impact, India is likely to get impacted much lesser as compared to any other competing economy, sheer because the GDP contribution from consumption is much higher. That is, India is a domestic driven economy. At the same time, India runs very less trade deficit with US as compared to other countries. So Indian trade deficit with US is only 4%, as opposed to China, which has trade deficit with US of around 24%. Mexico is around 14%, and Vietnam is around 10%, and so on and so forth. So India per se is likely to face lesser tariff as compared to any other in any other competing countries, which is likely to benefit India over a longer period of time. Although, as I have been saying, that these things are still at a nascent stage, and the final tariffs are, yet to be announced. We have to see how bilateral trade agreements are going with US. But prima facie, it appears that India might gain from the overall situation, and because the competing countries might face higher tariff, India could gain a market share in overall global trade. So this slides explain how each sector is placed in the current scenario. So pharma is, as of now, it is exempted, but like if we see overall, pharma's exports to US are very less value added as compared to European exports. So they are higher in quantity but lesser in value, and therefore the overall impact of tariff is likely to be minimal for pharma sector. IT sector might face second order effect because of slowdown in discretionary spending. So there is a possibility that US might run into recession, or US consumption might slow down. That will have impact on the discretionary spending, overall discretionary spending there. That might have some impact on the IT sector. And auto and chemicals are also some sort of consumption proxy sectors. So although direct impact on auto chemicals is likely to be minimal, because the net tariff for these sectors is likely to be lower than the competing countries, but the overall impact may be because of the slower consumption. Uh, then the textile, again, as I said, that even for the textile industries, countries like the Vietnam and Bangladesh might face higher tariff. Therefore, textile as an industry, there is a possibility that this will increase its market share in the global market. Metals, as of now, Indian countries are not exporting much to US. But if there is any tariff on metals, then we could face some dumping in the domestic market. So that is one risk which metal industry can face. So this is all about how India can be impacted because of the tariff. Just to conclude, that over a longer period of time, we feel that India could be beneficiary of the changes in global supply chain, which have benefited some of the countries like China, and other countries like Vietnam and Taiwan. There could be some reset because of the tariff orders which are coming, and India, there is a possibility that India could gain in the overall trade and could increase its market share going forward. So coming to our portfolio strategy in our small cap fund. So just small cap as a segment, if we see how SEBI classifies small cap, is first 100 companies are large caps, next 150 companies are mid caps, and 250 first to further companies are all classified as small cap. So small cap as a basket is a very large, very diversified segment. Even from the index perspective, if we see that in Sensex, three sectors like finance, information technology, and oil and gas, that constitute around 60% of the overall index, whereas in small cap, it is much diversified. The major three sectors contribute only 40%, and there are other sectors like transport, like logistics, media, then durables, textile, which are not part of the large cap index. So when we see India's story, all these sectors are likely to grow much faster than the real GDP growth. And these sectors are likely to be beneficiaries of that India growth story. So one can take exposure to this sector only through investing into small cap companies, because these sectors does not exist in the large cap index. So as far as small cap overall sector is concerned, it is much diversified, and there are niche business models available in this sector, which could grow much faster than the large caps. So we all have seen small cap index has risen substantially. Like post COVID, we have seen a major rally in small cap index, and like last since FY18, small cap index has gone up almost 3.8 times. But I want to highlight here that the entire rally of the small cap is driven by the profit growth. So if we see the index constituents profit growth itself has been 3.5 times in this year. So the as the economy has grown, even the small cap companies have grown, the profitability has improved, and that has driven the overall profit growth. And this profit growth has come with a very good overall constituents. So if you see that debt to equity for small cap as index has gone down from 1.3 to 1 times, that means the now the companies are much less leveraged as compared to they were at pre-COVID level. At the same time, ROCE of the ROC of this index has gone up from 5% to 11%. So almost like the return on capital employed has doubled over this period. So although we have seen some kind of re-rating, or small cap index trades at a premium to its historical median, but this is also justified by the fact that the overall constituents of the rally is are supported by the strong fundamentals. So herein, I want to highlight that if the fundamentals keep on increasing, keep on improving, we can see such kind of returns going forward as well. Then this slide is, this slide, everyone will agree that most of the multi-baggers we have seen from the small cap index. So basically, large cap, if you see how many companies have become 3 to 4 times, or in mid caps, the companies have become, 3 to 4 times or more than 5 times. The number we can see it is much higher in small cap. So over last say 10 years, in mid cap, less than 50 companies have become 3 to 4 times, whereas in small cap that number is as high as 200, and almost like more than 60-70 companies have seen more than 5 times returns. So this shows that small cap, if we pick a right company at a right price, then there is a possibility that we make outsized returns. And this is because small cap companies are largely, most of the time, those are under researched companies. Those are very niche business models. And it takes time for them to evolve as a business model. They can grow from that base, they can grow for a longer period of time, and because they are under research, they remain undervalued for a longer period of time. So there is a possibility that the re-rating could be the re-rating can take for a much larger time. So this is one thing that has driven the outsized return in small cap. But if we see, the stock selection in small cap is very, very important. So this slide is very important from that perspective, because if within the index also, if index has given say 18% return in 1 year, there are only 36% of the companies which have given above index returns. And 63% of the companies have given positive returns, but they may not be above index returns. So what this says is that the stock selection in small cap is very, very important. And although index has given positive returns, 37% of the companies have given almost like 16% negative return. So like this is a large number. So this much skewness within the index, you will not see in large cap or mid caps. So this is because, as I said, that small caps are very niche segment companies, niche sector, and the growth within the companies or within the sectors and the valuations can vary a lot. So it is a skill set of a fund manager to find these small niche growing companies at a right price and ride the wave of re-rating over longer period. Even if we see for a 5 years, it is the same analogy we can take, that although index as a whole index has given like 238% kind of return, but only 24% of the companies have given above index returns, and there are many companies which have given even negative returns or below index returns. So as far as small cap segment is concerned, the stock picking is very, very important, and that is where the fund management skills come in. So just coming to our investment approach, so within for us at Quantum, uh, we have a criteria. So as George has mentioned, that for us the liquidity as well as governance, these are two very important parameters for stock selection. And taking into consideration these parameters, we have carved out our universe, which is of around 980 stocks, which is like for small caps, we define liquidity of 2 crores per day. So we don't invest into any company which has a lower liquidity. And therefore, our current portfolio is also much liquid. We don't face any liquidity issues as far as current portfolio is concerned, and even if the portfolio grows in size. And based on our universe, then screening the stocks based on good capital allocation, the past financials, corporate governance, we carve out companies 450 stocks, and after that we meet those management. We see the which cycle is panning out, how the the growth is likely to be within the sector and within for those companies. Then we make models, or we make projections for 250 stocks, 5-year projections usually we make, and then we value those companies based on our valuation parameters. And of these 240 stocks, we make a portfolio of around 25 to 60 stocks. So currently we are holding around 52 stocks in our small cap portfolio, and every stock is driven by the process. So these are some of the features of quantum small cap fund. So as I said, that liquidity and market cap are very important consideration for quantum. So liquidity criteria, as I've already mentioned, that 2 crores per day liquidity is a minimum liquidity which we look at, and therefore in the current portfolio is also very liquid. At the same time, quantum has a very strong research capabilities because small cap is much diversified universe, and you require people to navigate to that diversified universe and identify those niche opportunities wherein we can get the earnings compounding as well as PE re-rating benefit to make those outsized returns. Therefore, research capabilities become very imperative for small cap universe, and quantum has built onto that. Emphasis on governance and management quality is something which we never compromise, and our the portfolio is speaks about itself. Past capital allocation, the overall cash flows, and our sustainable growth, sustainable ROCs are some of the parameters which we look into before investing, and therefore you will not see any momentum chasing kind of strategy for quantum funds. For small cap, we have a GARP approach. So anything which is, which is any business model which can grow sustainably over a longer period of time and can generate better return on capital, we value that company at a reasonable price, and then we build a position onto that. And all the investments in quantum have a long-term approach. So, we actually reap the benefit of long-term compounding. So this is again just to harp on the liquidity, as even SEBI has clamped down on many funds because small cap as a category itself is very small, can be very illiquid, and if we build illiquid portfolio in that, then when the fund size rises, the redemption will have a reduced returns for investors. So that is a major risk for in the current market. Some of the funds are facing. However, as far as quantum is concerned, we have taken into consideration that as a big risk, and therefore we have built our portfolio wherein we have very stringent liquidity criteria of 2 crores liquidity per day. And with the current liquidity, we can actually grow this fund much larger than the current year without compromising on our returns. So these are some of the themes which we feel that are beneficiaries of the current GDP growth what India might see over a longer over a next decade or so. So we have some positions in most of these themes. So financial inclusion is one theme which wherein the constituents are small finance banks, AMCs, mutual fund distribution, broking, and these like you have seen that mutual fund distribution, broking, you yourself are proxies to the financialization of savings, which has come to the stock market, and you've seen the rally driven by the domestic contribution, and therefore we feel that these are some of the sectors which will be beneficiary of that financialization and over a longer period of time. So still, the penetration level still remains in the range of 6-7%, and there is a long way to grow that, and this theme will continue to grow. Similarly, for small finance bank, as the credit availability has increased, these are the banks which will reap the benefit of that, and they can grow much faster than the lead banks, sure, because of the reach in the rural economy, and therefore we hold some positions there also. Secondly, renewable energy is one theme which we feel is a beneficiary of the government initiatives like solar panels, or the overall renewable energy capacity is likely to increase to around 350 gigawatt by 2030, and some of the sectors which are beneficiary of that are the power equipment, power distribution manufacturers, smart meter manufacturers, again the solar panel manufacturer itself. So we are positive on this scheme as well. And import substitution and China plus one, these two themes have again got an importance because of the recent event of tariffs, wherein the import substitution, there is one sector which is electronic manufacturing services, wherein India as of now has imports of around 70,000 crores in EMS as far as electronic manufacturing is concerned. And the listed universe itself, which we see of the electronic manufacturing services, it is only 10,000 crores. So in that large, still there remains a large import dependency of India. As things improve and the ecosystem in India, the supply chain in India gets built up, we feel that there is a long way for these manufacturers to grow within this theme and generate returns for investors. And China plus one, there is this API is one sector which can be beneficiary, specialty chemicals. We have seen some benefits coming post-COVID to India, and we feel that this will continue. Textile is one another sector which can be the beneficiary because after the current this Trump's policy impact, even that sector has got that sector has got a opportunity to improve market share in the global trade. So these are some of the things which we feel that will be the proxy to India growth story, and there will be good business models which will be built within these sectors, and therefore possibility to make good returns over a period of time. This is again, as George has mentioned, that upside capture and downside capture. So for quantum, we always remain focused on protecting our capital, and therefore in small cap also we have we have not we as we were feeling that some of the sectors or some of the companies were overvalued, we just did not build position just for the momentum plays or for to chase the momentum, and that has benefited us when actually the market has fallen. So initially, because of our strategy, there has been some underperformance, but as things are settling down and the market has corrected, the small cap has corrected from the highs, we feel that we have taken advantage of that, and most of the gains are reaped out of that, and now we are in a much better position to capture the next rally in the small cap phase. So with this, I will conclude, and we can open for the Q&A.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.